Hello everyone. In this learning objective, we describe hedge funds and discuss how it differs from a mutual fund. There is no clear definition of hedge funds. There are similarities and differences between hedge funds and other typical managed funds. One thing that the hedge funds and mutual funds are common in that they both engage in investment pooling. That is, clients contribute money in return of units and fund managers invest money in particular assets. However, there are a range of differences between hedge funds and other managed funds or mutual funds. The first difference is the legal structure. Hedge funds tend to operate as a limited liability partnership, whereas managed funds tend to operate as companies. Since hedge funds operate as limited liability partnerships, they are less susceptible to corporate regulations, so they will have lower disclosure requirements. But one of the negative aspects of this is that hedge funds are not directly advertised. So while you might see advertisement for managed funds in investment magazines, you won't see something similar for hedge funds. A second key difference is transparency. Largely because of regulations, managed funds provide a large amount of disclosure around the fund holdings, their policies, and their investment strategies. However, hedge funds will provide a very limited information, and they certainly won't provide you information about the particular investment strategies they're following. So this lack of transparency for hedge funds could be argued as being an additional risk factors. The third key difference is the investment strategies. Hedge funds have a huge range of solid investment strategies that they apply. Hedge funds will often take significant short position in assets, whereas most managed funds will not. Hedge funds will also engage in a range of different statistical arbitrage transactions, like they try to profit from what appear to be mispricing. These are often called risky arbitrage. Not perfect arbitrage, but a situation where you have two equivalent assets, but they have different prices. Hedge funds also seek to profit from investing in illiquid assets and assets that have negatively skewed return distributions. So they can generate the liquidity premium and the negative skewed premium. The fourth difference between hedge fund and managed fund is limited liquidity. Many hedge funds have a lockup period, which means that when an investor first invests in a hedge fund, they're not able to redeem units for a particular period of time, and this time period may be 7 to 10 years. Whereas these sorts of rules and requirements don't insist for managed funds. This lockup period is important because manager of hedge funds has the freedom to invest in illiquid assets that they can use to generate higher returns because they know that they won't have to liquidate some of the assets within their portfolio within a certain period of time. The final key difference is the compensation structure. We have seen before that managed funds will charge some percentage of assets under management that generally ranges from 20 to 150 basis points, whereas hedge funds, the compensation structure is much like a call option. Hedge funds will charge some fixed management fee plus a portion of profit. Portion of profit can be as high as 20% of profit that's generated above some fixed benchmark return. So a range of differences between hedge funds and managed funds demonstrate that hedge funds have several unique characteristics compared to other typical managed funds. So we spoke earlier about the key difference between hedge funds and managed funds is investment strategies used by them. Very exotic investment strategies are used by hedge funds. We can divide hedge fund strategies into two groups, directional strategies and non-directional strategies. The main idea of directional strategies is that you bet that one particular sector or another will outperform other sectors. In this particular case, you might still be having some exposure to broader market or economic movement. So that's why it's considered to be a directional strategy. You just take a bet with a certain segment of the market. Whereas non-directional strategy is an investment strategy, uh, which is basically an arbitrage type of strategy where you try to exploit temporary misalignments and apply security valuations. Based on security valuations, you strive to buy and sell securities, and then return will simply the premium or the return differential between these assets. Now we can see a more granular list of some of the particular approaches used by hedge funds, for example, convertible arbitrage, merger arbitrage, managed futures, distressed securities, and so on. As discussed previously, another key difference between hedge funds and managed funds is the fee structure. It's important to note that a typical hedge fund fee structure will be a management fee of 1 to 2% of assets under management, and this part of fee structure is equivalent to what we see for other managed funds. However, where a hedge fund differs is that there is also an incentive fee of 20% of investment profits beyond some pre-specified or pre-stipulated benchmark. So effectively, hedge fund manager has a call option on the portfolio with a strike price equal to current portfolio value. So what this incentive structure does is that it creates a situation whereby the hedge fund manager might be incentivized to act on a particular situation. If we think about the payoff for a call option, we know that call option becomes worth more when the underlying asset is more volatile. So in this particular situation, there may be an incentive for the hedge fund manager to invest in more volatile stocks as part of their portfolio, because that will effectively increase the value of their remuneration given a policy structure of this call option. Equally, a hedge fund manager will also be motivated to invest in illiquid and negatively skewed assets. Let's look at negatively skewness. Why will they be more willing to invest in negatively skewed assets? Well, this performance structure means that they get all the benefits of upside or positive returns and none of the detriments associated with downside. So with a positively skewed asset, you earn a small premium or a small additional positive return. In the case of a negatively skewed return, there is a small possibility of a big negative outcome, but because of the option-like structure of this remuneration, the hedge fund manager themselves won't suffer the loss associated with that being drawn. So they have an incentive to invest in both highly volatile and negatively skewed assets, and they tend to be the very asset that we do see hedge fund managers are typically investing. That's the end of our discussion on this learning objective.